You know, I must say one thing that, I mean, remarkable model. That's remarkably low cost of capital. How come? I mean, you've got your very impressive repayment record there, but I mean, I was looking at the coupon, and I was thinking to myself, wow, I mean, you know, that's not that far off what I would expect sort of investment-grade corporate credit to be trading at. You know, I mean, it's quite impressive level. I mean, how have you got it so low?
So I think for us it was a necessity. So I think the phrase is necessity is the mother of invention.
Absolutely.
If we're refinancing people whose coupon is 7, we figured out very quickly that the lower the rate was, the more likely the take-up. The more likely the take-up, the more efficient the funnel. The more efficient the funnel, the lower the business cost. So it became for us an absolute necessity that we reduce cost of capital. We believe that the credit segmentation that many other fine companies like Lending Club, Prosper, OnDeck are doing, we're doing in the premium segment. When we look at the big markets in the United States, of the almost $12 trillion consumer market, about $11 trillion enjoys pretty good credit. Our customers enjoy great credit. So we want to be with them with a compelling product in student loans, and then a compelling product in mortgages, and a compelling product. We have to have a premium product, a premium brand, a premium service level, and a premium technology interface.
Larry, let's talk with you. It seems like if you can get this proposition right, you know, a premium product, premium people you're lending to, securitization sounds like a walk in the park.
Well, I think what you're seeing today is, and SoFi was one of the first to jump in the space, is now the rating agencies are starting to get pretty active.
Yeah.
And so, my business, we provide primary and backup servicing for about $8 billion worth of assets.
Quite a few people in the room.
And 80% of the market here.
Yeah, exactly.
So you'll see this month the first rated peer-to-peer transaction for Prosper loans. Probably
right.
2 different funds will close this month, so it's really exciting. Recently, you saw the first duly rated small business and merchant cash advance transactions we were involved with Can Capital.
Yep.
And so that was pretty big for the space. Kroll has jumped in, as well as DBRS, and S&P and Moody's is looking at the space quickly here as well.
What's involved? Talk us through and I might come back to you, Nino. What's involved in the practicalities of securitization? Is it relatively straightforward? How quickly can you turn it around? What's the cost?
Well, I'm not an investment banker, and so, and I'll give a plug to Barbara, who's here as well, who has put the transaction together for SoFi and some other folks. Credit Suisse is involved, who's been very active here as well in the peer-to-peer space. But it's pretty straightforward. Everybody's trying to get the rating. I think that there's been about 10 transactions over the last 12 months, including Eaglewood, Garrison, and some others, which were all private transactions. Yeah. And then, the discussion is versus a private transaction or a public transaction deal. Some of the thought process is, should I give up, maybe a 1/4 point in yield, a 1/2 point in yield, and not have to pay all of the rating agency fees? Am I limiting myself to certain investors or not? And so those are the discussions that are going on today.
And Nino, what's your take on that public versus private securitization debate? Where did you come to on that?
I mean, I think for us, we believe ultimately for our success, we have to have access to all of the investors in the world.
Yeah.
Certain investors like information and data and, frankly, assets in certain forms. And it's incredibly important to fulfill investors just like we satisfy borrowing customers in the manner they like, and many of them, for regulatory and subscription reasons, require securities. So it was a necessity for us to go down that path. It was not our most cost-effective capital.
I was going to ask, it's not you could presumably just go to a couple of key...
We have more cost-effective capital, but the long-term balance is extraordinarily important, that the virtuous cycle of letting folks know what the assets are, being transparent, drives cost of capital. When we drive cost of capital down, we plow it through immediately into a reduction in our borrowing rates for our customers.
Yeah.
Our objective is to improve the customer and get more assets for us that are satisfying both investors and customers.
I mean, Larry, yeah, but that's interesting, that private versus public debate you raised there. I mean, presumably it'd just be a lot easier to do it privately, isn't it? I mean,
well, you had a lot of discussion around this morning on some of the earlier panels and Ron's keynote. I think a public transaction is very good for the industry right now. I think that it's going to open up additional opportunities, not only for the platforms, but for the institutional investors that are buying the whole loans here. And so we're pretty excited about the first public transaction that's going to take place this month.
Do you, and just one last question, I'll come to Cedric. Do you think that in the next 2 to 3 years, the vast majority of transactions will be done via securitization, or do you think it will remain quite small?
I have my own views on the space, but I think that in the next 24 months, you're going to see a major consolidation of platforms in the U.S. here. We're getting calls every single week from brand new folks that have ideas around a platform, whether it's wedding loans or adoption loans. We're seeing all different types of platforms. I think you'll see that shakeout. Typically what happens, it's, Matt was up here a little bit earlier with his ecosystem slide.
Yeah.
Typically they
a lot of companies on that slide.
Yeah, they sometimes go to Orchard first. They typically will funnel their way over to WebBank. In many cases, they go over to our friends at Cross River who provide an origination charter. They come to us. And so we're starting to see some tightening between the ecosystem companies by saying, hey, you don't really have a viable business, and let's hold off at this point.
Cedric, what's your take on this? And explain your business model a little bit more.
Yeah, sure. So Finexkap is actually two things. We are a receivables financing company, but we do it with securitization. I mean, Edwin mentioned it before. We are a tech-oriented company on the one hand. We actually originate receivables on the web and through technology. So we plugged in accounting softwares, invoicing platforms, ERPs, that sort of stuff, that allows us to originate the receivables. And we have another company in the group, which is the equivalent of an SEC registered advisor, but it's licensed in Europe. And the idea, we set up an investment fund which securitizes the receivables we originate, and we place financial instruments, notes, basically, in the market. So we are actually a schizophrenic company because we have people that know factoring, and credit analysis and the usual suspects of the receivables financing business. But we also have people that, have the securitization expertise. So people that, allow us to structure products. We're in a private securitization market. We're not public yet. We need track record, something that, obviously you have, we don't yet. The idea is taking the time to get a track record and maybe having, a rating down the road. We've already started discussing with rating agencies, but they need track record, basically.
And obviously both Larry and Nino are operating in the North American market, the US market. Do you think there'll be an appetite for securitization in Europe as well?
I definitely do so. I mean, originally, Finexkap was marketplace-driven. We really liked the model of the market invoice and, receivables exchange as sort of, companies that were pioneers of this. Again, even invoice discounting is not new, they were pioneers in this type of product. But we realized that if we really wanted to scale, and that's just our perspective, we needed to get rid of the friction on the investor side. We didn't want to have investors get a look at the receivable, rating the receivable, selecting the receivables. That's for us too much friction. We really wanted to internalize all of this, and the only way to do so is you securitize it. You just set up an investment strategy. Obviously, you set up models, so we worked for a lot of time, just on the models. We worked on about 7 billion euro worth of receivables before actually plugging the models into the product. And yeah, securitization is the only way for us to get, lots of capital. And I agree with something that was said earlier. I mean, when you have lots of capital, you get origination down the road. I mean, they come to you. That's what we've seen. We opened the beta program in October 2013. 1,400 companies registered on the platform without zero marketing expense, zero marketing expense. And that's just because, obviously they saw us as backed by institutional investors. We're backed on the, funding side, institutional investors, large corporates, hedge funds, family offices, not retail at all, really, accredited people. And that's, that gave a message on the market.
Okay, we're cruising towards the end here, but thank you very much, all of you. And I'm sure a lot of you will be picking up with the conversation about securitization with these gentlemen in a minute. But if you put your hands together, thank you very much.